Hi traders, it's Bruce Banks here, and I'm going to go over a key Forex trading strategy. And this is something that I think should be taught as one of the first things any trader learns, and should be one of the key things that every experienced trader looks at when they're doing technical analysis, because there's so much value behind this. It's the highs and the lows. Now that might seem like an incredibly common and simple subject, but you can really go into depth on this. And I have before, but this is going to be a brief overview giving you an understanding of it. Now, if we just mark off and look at this one chart, we're on the Euro US dollar right now, and we see there's highs and lows in the market. But the key thing to look at is exactly what these highs and lows represent. And what they represent is extremely significant. It's an agreement between buyers and sellers at that specific time on the maximum or minimum value of that Forex cross. It might not seem too significant, but it really is, because that's every trader out there who's trading right now, and as a whole, the people have their stops in, the people have their buy and sell orders in, that's an agreement on that price. And so we have to pay a lot of attention when we're doing a high-low analysis on these levels. Take, for instance, this high here. Now this is extremely significant, because in this period that we're looking back right now, and this is spanning multiple months all the way from August till now November, this is as high as the market was able to make it. So what that tells us is exactly that at this point, the market decided that this is the most anyone was willing to pay for this. Similarly, we look at the more recent one here, and this is the level where traders agreed as a whole that this is low enough. Where there's going to be support in the market. There's traders flooding into this market at this point saying that's low enough. We're ready to buy as a whole. Now, what causes these on a chart? It's an important thing to actually dive into. You're looking at the market psychology behind this. And the market psychology, one of the aspects of it is the agreement between these buyers and sellers. What causes that agreement? It could be an entire host of things. The markets go up and down for varying reasons. We're looking at a Forex cross here. It could be bad economic data coming from the USA or Europe, forcing the market up or down. It could be a trade deal going through. And there's a lot of fundamental analysis that goes into those reasons. Now, I'm more of a technical trader, and I don't pay as much attention to fundamental analysis outside of a general overview. And one of the reasons I'm able to do that is because I analyze the highs and the lows in the market. Because by analyzing these highs and lows, I'm able to, instead of looking at the fundamental analysis and picking apart the news data, I'm able to analyze exactly what that news data displayed in the reaction to it on the charts. Now, I've gone more into detail on this subject in other videos and other courses, but the brief overview is you can see if you outline the highs and the lows, we have a continued series of lower highs. Now, what's that tell us? That tells us the general consensus is the fact that, say, we made the market high here. Now, as the trading continued on in the year, it pushed down, because you're going to get ups and downs in the market. That's just what's going to happen. But they were only able to push it down so far. Now, it's rarely going to be a straight run to the bottom unless, say it's a stock and there's absolutely no value, or, say there's a horrible thing happening in the currency, or in the country that the currency is based in, and there's no faith left in that currency. In the major crosses, we're not going to really see that too often. Something like that happened with the Euro CHF, the Swiss franc, when they decoupled themselves from the euro. But again, the faith came back. It wasn't a total race to the bottom. There is a bottom where traders had faith in that again. But the key thing we're looking at here is exactly how far down they were able to push the market. Because we had a lot of people, there were people at the very top here who bought at 143.68. There were people that had faith that the market was continuing upwards. And there were a lot of people who had faith the market was overbought, and the fact that you could push it back down. in the short term, they were correct. They pushed the market back down. And this point is extremely significant here, this first low, because this is where the sellers lost their momentum. This is where the buyers came in and said, no, this is a good price for this pair right now. We want to take this and we want to actually put in a lot of volume and buy here. And they were able to regain control of the market. They managed to push the market back up to the new high. Now, it's really important to take a look here and see that it's a lower high than the previous. So all the strength that the buyers had in this market wasn't enough to even push it up to create a new high. Not only that, but it was a doji bar. So they weren't even able to push this market up and close the market at this level. They were able to push the market up intraday, but the really key thing to look at here is the fact they didn't close the market at that higher level. The reaction the next day from this not only lower high, but lower doji bar high was the fact that there was a contention in the market. They were still trying, the buyers were still trying to push this market up here, but they failed and ultimately ended up with another low. And if we look at this, it's actually a lower low than the previous one. Not by a large margin, and itself is a long wick going down to that. But if we just look back, we ignore the right side of the market here. What do we have? We have definitely a significant looking lower high, and we have two lows that are near identical, but the market had more strength here on the downside, and that's extremely clear just by looking at this price contention, or these highs and these lows, and the disagreement between buyers and sellers. So what happens next? The market's not going to go straight down. So the market makes another attempt upwards. They push up in the market and they make a new high. Now, here is really where the buyer's case for, thinking the market's going to go up kind of starts falling apart, because the high that they make is nowhere near the previous two. So all of the buyers are looking at this data before them, and they're seeing the exact same thing that all the sellers were seeing, and they're seeing that the buyers are seeing that they just don't have the strength in this market. And that's when you get the fall off. That's when you get all of the faith that the buyers had slowly dwindling. They're putting in their stop loss levels right around this level, because these lows were retested once and twice. So they're putting their stop levels in below there, because they're like, if the seller's thinking, if it goes below this, then we're in for a bad time. And you see this as the market, we fail on this new high, and the market starts coming back down. And as soon as it breaks this low, we tried one day here, and the sellers were able to keep it up. But as soon as the buyers came in and started forcing the market down, the stop orders got hit, and the market rocketed down to a new low, which again is extremely significant, because we have to look at this new low. And this new low is stating the fact that all the sellers that, all of the buyers that were back up in here, all the way back in the chart months ago, they're coming in now and they're saying, no, this is the level. This is the line in the sand that we're drawing. And we think this is a good price to buy this particular Forex cross. So they come in with strength. And like I said, it's never a straight run up. We're never going to see that. We're going to see a run up, and then there's going to be that point where the market turns around. And we've just recently hit that here with this new high. Now, what's that tell us? Well, it actually bounced right off of the level right here where we had the two previous lows, and it came right up to those two previous lows. One thing we have to think about is the fact that these levels of price agreement where the market turns around can be considered as points of support as the lows and resistance as the highs, but also once the market's broken below them, they actually become points of resistance for the market. So now that the market's coming back up here, to break through these two lower levels is an area of resistance for the market. So we ended up having the market come up, bounce off of that point of resistance that used to be prior support for the market. This is an extremely brief overview on this subject, but it's one that I've gone into detail in many of my videos, and I think it's such a basic, simple concept that you can look at on any chart without any charting software. You can pull this up on any of the online platforms and take a look at it and do a really in-depth analysis on exactly what highs and lows are telling you about the market. And more importantly, understanding exactly why these highs and lows are created.